Wealth is not just about what you earn, it's about where you park it, how you protect it, and whether you treat the structures available to you with the respect they deserve. Your 401k and IRA are trusts. Start acting like it. You probably think you have a retirement account. Let me stop you right there. You don't. What you actually have is a trust. And until you start treating it like one, you're leaving the single most powerful wealth protection tool in the tax code completely on the table. Most people open up a 401k or an IRA the same way they sign up for a streaming service. Click here, pick a date, select a fund that sounds smart, done. That is not what just happened. When you opened up that account, you created a legal trust structure under the Internal Revenue Code. You appointed a trustee. You named beneficiaries. You accepted fiduciary responsibility over a pool of assets that the government has agreed in writing to protect from creditors, from current taxation, and from your own worst impulses. And yet almost nobody runs it that way. I'm going to help you reframe everything. This isn't financial advice. I'm not your advisor, but a structural look at what you built when you opened the account and why viewing it through the lens of a trust changes every decision you make from here forward. Because once you see it, you'll never look at contribution limit the same way again. Let me start with an analogy. Imagine you own a castle and inside that castle is your gold. Now you can keep that gold in your bedroom. It's yours. You can touch it. But anyone who sues you, any creditor, any judgment, they can walk right into that bedroom and take it. Or you can move that gold into a vault. This vault is different. It's not technically yours anymore, not in a legal sense. It's held in trust. There's a trustee guarding it. There are rules about when it can be accessed. There are tax benefits for parking it there, and there are penalties for breaking the rules early. But the trade-off is powerful. The vault walls protect that gold from most outside threats. Here's what most people miss. A 401k and an IRA are that vault. The moment you contribute, you are not just saving for retirement. You are transferring legal ownership of those assets into a trust structure governed by the IRC sections 401 and 408. The plan trustees, whether it's Fidelity, Vanguard, or your employer's plan administrator, holds legal title. You hold beneficial interest. That distinction matters more than almost anything else in personal finance. And almost nobody learns it in school. You did not open a savings account. You established a tax-advantaged trust with creditor protection, deferred growth, and statutory guardrails. And you did it with a few clicks on a website. The question is whether you're going to keep treating it like a savings account or whether you're going to start managing it like the wealth protection vehicle it is. To really grasp this, I want you to picture three hats sitting on a table. The first hat says settler, the second says trustee, the third says beneficiary. In a traditional trust, the kind wealthy families set up with attorneys and corporate fiduciaries, if they don't know what they're doing. These are usually three different people. In your 401k or IRA, you are wearing all three hats at once. That is either incredibly empowering or incredibly dangerous, depending on how seriously you take each role. Let's break down what each hat means because this is where the investor perspective comes in. Settler, that's the person who creates the trust and funds it. When you elect to defer a percentage of your salary into your 401k, or when you contribute earned income into an IRA, you are the settler. You are making the deliberate decision to move assets out of your personal name and into a protected structure. That decision has tax, timing, and legal consequences. A settler who understands this does not just set it and forget it. A settler tracks basis, monitors contribution limits, and documents the source of every dollar. A trustee is the person responsible for managing the trust assets. In your employer plan, the named trustee might be a financial institution. In a self-directed IRA, that hat might sit closer to your head. But even inside a standard 401k, you are making the investment selections. You are deciding between the S&P 500 index fund, the target date fund, or if your plan allows it, a brokerage window. That is a fiduciary act. You are directing trust property. And if you are making those decisions based on a tip at a barbecue, you are breaching that fiduciary duty you owe to the beneficiary. Now let's get to the beneficiary. That is the person who ultimately receives the benefit of the trust. That is future you. That is your spouse. That is your children if something happens to you. The beneficiary documentation on your 401k and your IRA are not administrative afterthoughts. They are dispositive documents. They determine who gets what, when, and under what terms, outside of probate, outside of your will, often with tax consequences that dwarf whatever is in your estate plan. When you look at your retirement account, let's see a balance of $50,000. You are not looking at a number. You are looking at a trust structure with three roles: a trustee agreement, a beneficiary designation, and a federal statute standing guard over the whole thing. The investor who understands this does not check their account once a year. They manage it like a fiduciary managing a family office. Let me tell you why the trust frame matters in the real world. Let's say things go sideways. You get hit with a lawsuit, a business deal blows up, a medical debt spirals out of control. In most states, your personal bank account is a sitting duck. Your taxable brokerage account, it's fair game. Your house, depending on homestead limits, may be protected, maybe not. Your 401k, that is protected under federal law. ERISA qualified plans, which include most employer-sponsored 401ks, enjoy anti-alienation provisions. That is a legal term that means creditors generally cannot touch it. Not credit card companies, not most judgment holders, not even some bankruptcy trustees. IRAs are slightly different. They are governed by state law in bankruptcy contexts, but in many states, they are equally shielded. And even where state protection is limited, federal bankruptcy exemptions protect up to about 1.5 million indexed for inflation. But it's not an accident. That is Congress saying we've created a trust-like structure to ensure that you do not retire destitute. Think about it for a second. The same government that will tax your paycheck, your dividends, your capital gains, and your death. That government has drawn a line around your retirement account and said, this is a protected space. Why? Because structurally, it's treated as a trust for your benefit, not as your personal property. The investor who understands this starts asking different questions. Not what fund has the best return this year, but how much of my net worth is sitting outside protected structures, exposed to claims I cannot predict. Your 401k and IRA are not just tax deferral tools. They are creditor-shielded trusts that Congress has statutorily insulated from the chaos of your own personal balance sheet. Every dollar you leave in a taxable account instead of maxing out these structures is a dollar you chose not to vault. Now let's talk about the IRC perspective, the Internal Revenue Code, because this is where the architecture gets beautiful. Most people hear tax code and think of April 15th, and they get a headache. But the IRC is not just a rule book for what you owe. It's a blueprint for how the government wants you to build wealth. Section 401 and Section 408 are not penalties. They are invitations. They say, if you are willing to lock your money into a structure with some guardrails, we will give you extraordinary benefits. Deferred taxation, in some cases, tax-free growth, creditor protection, estate planning flexibility, the ability to pass assets to heirs with stretch provisions that can compound for decades. This is the government essentially saying, we will partner with you on wealth creation, but only if you use the structures we designed. That structure is a trust. It has a trustee. It has beneficiaries. It has contribution limits that function like capacity constraints. It has distribution rules that function like trust terms. It has prohibiting transaction rules, which is IRC Section 4975, that penalize you for self-dealing, which is exactly what traditional trust law prohibits. When you look at it this way, the Roth IRA is not just pay tax now, grow tax-free. It is a grantor trust, where you voluntarily pay the tax on the seeds so the harvest is clean. The traditional 401k is not just deferred tax until retirement. It is a non-grantor trust where the government is your silent partner, deferring its claim until you activate the distribution trigger. The investor asks, what is the government's incentive here? Why would they give me these benefits? The answer is structural. They want you to be self-sufficient in retirement so you do not become a liability to the state. They have created a trust framework, and they are subsidizing your participation in it. The IRC does not hate you. It's offering you a blueprint, and the wealthiest families in America have understood this for generations. They do not avoid trusts. They use them aggressively. Your 401k and IRA are the only trusts most middle-class Americans will ever touch. The tragedy is that most of them never realize what they have. Here's another analogy. Imagine you're building a fortress, not a castle, and every year the government says you may add this many bricks. This is contribution limits. Most people look at the limit and think, okay, that is how much I'm allowed to save. Wrong. That is how much legal capacity you have to move assets from your personal, exposed balance sheet into a protected, tax-advantaged trust. It is a use it or lose it annual allocation. You cannot go back and fill up last year's fortress. The walls only get thicker if you consistently move bricks. And here is where the investor perspective gets aggressive in a good way. If you are not maxing out these accounts, you are not just missing a tax break. You are voluntarily leaving assets in an unprotected taxable structure when a protected tax-advantaged structure was available. You are choosing to build your castle out of straw when the IRC offered you stone for free. Self-employed, you have access to a SEP IRA or solo 401k with even higher capacity. This is not a bonus. That is a larger vault. High earners, you might need backdoor Roth strategies. That is not a loophole. That is using the trust structure as designed, with proper documentation, because the IRC allows. The settler who understands this treats every January as a deadline. Not a suggestion. The trustee who understands this reviews the investment policy statement inside the account annually. The beneficiary who understands this names contingent beneficiaries, so the trust structure survives even if they do not. Contribution limits are not savings goals. They are structural capacity limits on the most powerful trust vehicle available to everyday investors. Miss them, and the opportunity is gone forever. Use them. You're compounding not just returns, but legal protection and tax efficiency. I'm going to close with the most overlooked part of this entire structure, your beneficiary designation. If you have a will, you probably think that document controls where your money goes. It does not. Not for your 401k, not for your IRA. These accounts pass by operation of law directly to the name's beneficiary. That piece of paper you filled out and you open that account, that is your trust distribution instruction. And if it says estate, or if it names an ex-spouse you forgot to update, or if it is blank, you've just created a probate nightmare, a tax acceleration event, or a windfall for someone you did not intend. In a traditional trust, the settler spends thousands of dollars with an estate attorney to craft precise distribution language, if they don't know what they're doing. In your retirement account, you did it in 30 seconds on a website and probably never looked at it again. The investor perspective says this is not a formality. This is the dispositive heart of the trust. If you have minor children, a direct beneficiary designation can force an immediate distribution they are not ready to manage. If you have a special needs family member, a direct payout can disqualify them from government benefits. If you have a spendthrift heir, a lump sum IRA distribution is a match in a pool of gasoline. Solutions exist. See-through trusts, conduit trusts, accumulation trusts. These are not exotic offshore strategies. These are standard trust tools applied to your IRA or 401k beneficiary designation. So the retirement account continues to function as a trust after you're dead, with the same creditor protections, the same tax efficiency, and the same fiduciary oversight. Your beneficiary designation is not a contact form. It is the instruction manual for what happens to the trust after you die. Treat it with the same seriousness you would treat a $10,000 estate plan, because that is exactly what it is. You were sold a retirement account. What you bought was a trust, a federally protected, tax-advantaged, creditor-shielded estate planning vehicle with 3 roles: statutory guardrails and an annual capacity limits that expire. The difference between someone who retires comfortably and someone who does not is often not income. It is structural awareness. It is understanding that the IRC has already built the vault, and your only job is to fill it, manage it prudently, and make sure that walls stay thick. If you walk away from this video with one shift, let it be this: stop checking your 401k balance like it's a savings account. Start managing it like a fiduciary running a family office. Review your beneficiary designations. Max out your capacity. Document your source of funds. Wealth is not just about what you earn. It's about where you park it, how you protect it, and whether you treat the structures available to you with the respect they deserve. Your 401k and IRA are trusts. Start acting like it. If you found this reframing useful, subscribe. We talk about financial architecture, tax literacy, and structural side of wealth that most people ignore. And if you're building something complex, a business, a portfolio, a life across borders, you know where to find us.